Hey everybody, it is Saturday, May 30th, and this is probably my most heavily requested video, and it is my monthly profit and loss statement for this past month of May. So I will try and make these videos at the end of every month, so stay tuned for those if you're interested, but you could always go back and watch all of my prior videos because I post daily and just keep track of the trades. But just to get started, as you can see, from the first week of May, my first trade was actually selling a covered call on AMD because I was assigned those shares the week prior, and I actually had 400 shares of AMD at an average cost basis of $51.75 per share. So I sold the strike of $52, and that was a weekly option, and it got called away, or I got my shares called away that week, which is what I wanted. So I collected profit from selling the premiums, and then I also collected a total of $100 in stock appreciation because I owned them at $51.75 and my strike price was $52. So I collected 25 cents of stock appreciation per share, and I had 400 shares, so that gives me an extra $100. So that's what this first line represents. And then for the rest of the month, predominantly I sold cash secured puts without getting assigned except for on AMD, which I'll talk about in a minute. So then the following day, after selling the covered call, I opened up another cash secured put on AMD with a strike price of $49. So in effect, between the trade I opened up on May 4th and the additional trade I opened up the following day, I essentially had a strangle going on AMD at the time because I had both a call and a put on it at the same time, which was interesting because I've never actually traded a strangle before, but it was because I had opened up a call and a put on AMD. So in theory, it was possible that I could have get assigned 100 shares on AMD again, and then I would have ended up owning 500 shares of AMD if this call didn't get called away and I got assigned the put. But that didn't happen, like I said. And as I've stated in many other videos, I really like AMD as a stock. It's been very good to me. So I would have been okay getting assigned the shares. And plus, that put was at the $49 strike price. So even if I did get assigned those shares, it would have further lowered my overall cost basis per share on AMD. And then the following week, I decided to trade IWM, which is the Russell 2000 ETF, for the first time. And so I sold a put on IWM at the 127 strike price and actually ended up getting assigned those shares. But I did collect $104 of premium because I only sold one contract. And then the following day, I opened up yet another cash secured put on AMD at the 51 strike price, which did not get assigned to me. And then, if you remember from my prior videos, I had seen some unusual options activity in that someone was willing to buy an $8.50 strike put from me, and it was so far out of the money that I was very happy to sell to them. So I sold 3 contracts at a return on risk of 0.4%. So this was pretty much easy money for me. But I've been looking every day since, and that was very unusual because I haven't seen any other very far out of the money put orders on space since then. And so the following week, because I did get assigned those 100 shares of IWM at $127, I sold flat out the stock come Monday morning. And actually over the weekend, the stock went up $4.45 per share. So I immediately just sold the stock outright because I didn't want the stock price to drop and for me to lose any potential gains. I just wanted to lock in those profits. So I immediately made $445 just by selling my IWM stock off in stock appreciation. In retrospect, that wasn't the greatest move because IWM currently is trading in the high 30s and sometimes even in the low 140s. So if I had held my IWM stock, I could have maybe doubled or even more my stock appreciation. But how would I have known that? Hindsight is 20/20. And the good thing is that this freed up capital for me to get into other positions. So there's always another trade out there. You can't always, buy at the very bottom or always sell at the very top. It's just impossible to do. You can't predict the future. And then, so the following week, I sold another put on IWM at the 123 strike price, so even lower than my initial put. And that was not assigned because, like I said, IWM just took off after I sold off my shares, and I just collected $60 in premium without getting any shares assigned. And then the following 2 weeks, or the most recent 2 weeks, I've basically been playing AMD in that I've just been selling cash secured puts at the $52 and $50 strike prices. So if you just watched my video from last week I had $50 and $52 puts that I had sold on AMD for a total of 5 contracts. I had 2 contracts of the 52 strike and 3 contracts of the 50 strike. And AMD closed a little over $53 per share. So all 5 contracts expired worthless. So I was able to collect my premium free of charge and not get assigned any shares. So in this column, you can see my overall profit and loss for each trade I made. This line, the 445, represents the IWM stock that I just sold outright. This was not an options trade. And then here in the stock appreciation column, I have 100 because I sold the covered call, which got called away at the $52 strike price. So I collected 4 contracts, or 4 times 67 cents per share. So 4 times $67 plus the $100 I received from stock appreciation, because again, I sold the stock at $52 a share, but I owned it at $51.75 per share. So here you can just see how many days I've held those trades. So, you know, as you can see, I pretty much trade weekly options. And this is not very useful, but I just have it automatically calculated just out of curiosity. And it's the annualized return on risk. So basically, it just determines what my profit was in how many days and calculates if I was able to do that every period for the whole year. So for example, in this trade, I collected $265.51 in 4 days. So if I can do that every 4 days for a year, that would be a 9,000% return on my money. I mean, this is, like I said, this is just for fun and just out of curiosity, because this is not practical. The real column that I like to look at is the return on risk column. So I've mentioned in my previous videos that I like to get at least a 0.4% return on my risk. Anything less than that is just not worth it to me. I feel like my money can make more money with other trades or be used elsewhere. So as you can see, the vast majority of my trades are 0.4 or 0.5-ish% return on risk. And that's because obviously everything is a risk to reward ratio. So the lower your return on risk, the higher probability you have of it happening, right? So my most risky trade was this AMD put that I had sold this past week at $52, because that had a return on risk of 1.22%. And that showed because this week there were a few times where AMD dipped below 52. And honestly, really up until 3 p.m. yesterday, I was concerned, or I wouldn't say concerned, I was fully expecting to get assigned those shares, meaning it wasn't a lock. So, and that's reflected in my high return on risk. So luckily it worked out in my favor in that I did not get assigned those shares. I mean, honestly, and I've stated before my video from yesterday, I kind of wanted to get assigned the shares because I knew AMD was going to go back up. So if I owned AMD at 52, I could have easily turned around Monday or Tuesday and sold it at 53 or 54 for another easy $100 or $200 in stock appreciation. So it depends on how you look at it, but as of right now, as of end of day yesterday, because it's the weekend, I am 100% cash. I don't own any stock and I have no options open right now. So come Monday morning, I'll look to get into more options trades, and I'll make a video tomorrow, of course, depending on, trying to decide which trades or which stocks I'm looking at and which options are looking good to me at the moment. But as you know, everything changes come Monday morning when the market opens. If you watched my video from last weekend, I had some possible plays I was looking at on Chewy and IWM. And then once the market opened Monday, they really weren't looking good to me. AMD was looking good to me, meaning it did what I wanted to do. And so that's why I put kind of all of my eggs in one basket this week by all 5 contracts of AMD. I wouldn't recommend that every time because you're putting all of your eggs in one basket, and if let's just say AMD happened to have some really bad news this week and just plummeted, well, now all of my portfolio is tied up in AMD. So you really should try and diversify and getting into different sectors and different stocks. That way, if you get assigned some shares, it's okay. You still have some free capital to make other plays. But, do as I say, not as I do. That's the saying, right? And as you can see, I just keep track of which options are still open or closed. I don't make a lot of plays at the same time, so it's really easy for me to keep track of them in my head. I even have a little cheat sheet that I keep by my computer on a piece of paper that have my trades on. But as you can see by this Excel sheet, I only have maybe 2, maybe 3 plays on a week at a time on 2 or 3 different stocks, if that. I know there are some traders that like to have 10 or 15 positions open at a time, and they sell 30, 45 day to expiry options, and I just think that's a little bit too much for me. I think for that I would have to basically be on my computer all day every day during market hours, just watching and trying to keep track of what every stock is doing, and that's just a little bit too much for me. I just want to try and make a little bit of passive income and have some side money that is quote unquote relatively easier than working a 9 to 5. I mean, that's my objective. I'm not, obviously with my portfolio right now, I'm not making a living per se off this, meaning I can't quit my day job or just rely solely on my investment income, but I'm not doing too bad. So if you tally all this up and just add up all of my profits and losses and add my $100 of stock appreciation, you'll get a total monthly profit of $1,303.24 for the month of May. And so my portfolio value at the beginning of May was about $25,522, and my portfolio value as of today is $26,825.56. So that's just $25,522 and 32 cents plus 1303.24. And so if you were to divide my profit from this month by where I started the month, that's a 5.11% return for this month, which is pretty good. If you were to do some, again, this is not 100% accurate, but some quick and dirty annualization, if I could get a consistent 5.11% every month for a year, that would be over a 60% or 61% return on my portfolio for the whole year, which is not too bad. I mean, let's just say in theory, let's say I started with 25,000 January 1st of this year. I mean, I didn't start trading until a little bit later, but just hypothetically, 25,000 January 1st. And if I were to annualize that and multiply by 1.6, because that's, let's just say 1.61, because that's 61%, I would be left with $40,250 at the end of the year. So that would be a total profit of $15,250 over a year if you can consistently get 5.11% return every month. I mean, this is hard to do because if it was easy, everybody would do it, but it's possible right now just because the market is so volatile and the options premiums are more inflated than they usually are, just because there's so much fear in the market. So that's how I'm trying to take advantage of it. Now, another question people may be asking is, is that good or is that bad? Meaning, if you were to just take your 25,000, or let's say May 1st, you took your 25,522 and you just invested it all in an ETF, meaning in SPY, the S&P 500 ETF, or all in IWM, or all in QQQ, the NASDAQ 100 ETF, or in a total market index fund, did I do better than just putting my money into one of those accounts and just letting it sit there and not touching it at all? So I went to this website called barchart.com, that's BARCHART.com, and you can actually compare different stocks. So what I did was I put in 4 different stocks or indices, and the thin gray line here is SPY, which is the S&P 500 ETF. Very, I mean, I think it's the most liquid equity that you can trade. And I put in QQQ, which is the blue line, which is the NASDAQ 100 index, and that is very, very tech heavy. And as you know from the news, tech has really been just carrying the market because all their stocks are going up and down. Tech like Amazon and Facebook and Google have just been going up. So tech has been a good sector recently. The orange line is IWM, which is the Russell 2000 ETF, which you're familiar with if you've watched my previous videos. And then the purple line is VTI, which is a Vanguard total market index. And I just chose the Vanguard because it's pretty popular, but Charles Schwab, Fidelity, they all have their own versions of the total market index. So it incorporates the whole market, not just the S&P 500 or the NASDAQ. And what I did was I sorted this by the last month. So actually, being that it's May 30th, it starts at April 30th. So it doesn't really start at May 1st, but it doesn't make that much of a difference. And I'll draw your attention to these percentages at the end of the graph. So what that's showing you is that if you were to invest in these stocks April 30th, over the past month, this is your percent gain. So if I had put in that money or any money in IWM, I would have gotten a 2.5% return this month. If I had put it in SPY, I would have gotten a 3.7%. The purple line is covered up, but it's actually 4.01%, and that's for VTI. And I can show you if I expand this graph here. See, it's 4.01%. So VTI would have returned, the total market would have returned 4.01%. The only index that I did not beat was the NASDAQ 100, and that was QQQ. So if you had put in all of your money at April 30th in QQQ and just let it sit there, you would have been up almost 6.5%. So I was up 5.1% by actively trading. So I beat the S&P 500, I beat the total market, and I beat the Russell 2000. It's just the tech stocks that I didn't beat. So that's interesting. Now, you also have to keep in mind though that, you know, you may be saying to yourself, well, that was dumb. You would have just made more money doing a whole lot less work, right? Just literally just dump your money into QQQ and don't do anything with it. Just go to sleep and do your own thing. And you could have cashed it out yesterday or even today and made more money than I did. That's true, but you also have to keep in mind that there's no guarantee that this is going to keep going up, meaning there's no guarantee that this following month QQQ will have the same or higher return. So for example, like let's look at this period here, which is roughly May 12th. And it looks like at this point, all of the indices started dropping down. So up until this point, QQQ was, and I'll draw your attention to this percentage here, up 4.08% from April 30th. So if that's the case, then the coming days it dropped. It dropped so much that actually QQQ was negative 1% on May 14th here. And actually all of the indices were negative because here's the 0% line. So the blue line is below, the gray, purple, and the orange line are definitely below 0%. So from April 30th to roughly May 13th, May 14th, you would have lost money. You would have been in the red. You would have been negative. However, if you go back to my chart here, thankfully, and knock on wood, I was never in the red all month. I never lost money. All of my trades were profitable. And again, I'll knock on wood again because that was a little bit of luck and a little bit of skill, but I was never in the red. So if we were to end this graph, let's just say in the middle of May, then I'm looking like a superstar because everyone is losing money in these indices while I'm still in the green. So, and the other thing you have to keep in mind is that if you just put your money in these indices and just let it ride for months or years or decades, that money is not usable to you unless you cash it out. By me selling options and getting money every week, that's cash flow for me. So for example, this past week, I was fortunate enough to make $200 on my AMD positions. Let's say I needed to buy some new tires for my car, right? Because my tires are worn out. Well, I can use that $200 now that I made, and I'm not accounting for any taxes that I have to take out, but just for argument's sake, I could go and use that $200 that I just made and go buy a new set of tires for my car. I can't do that with my money in these indices unless I cash them out. And then at that point, you start over again, right? Because then your 0 point is not April 30th, your 0 point is whatever, May 14th or whenever you cash it out. And then if you decide to reinvest that money, you start over. So trading options gets me what they call cash flow, meaning it's just like another income. I keep getting another. The way I think about it is I keep getting another paycheck every week. So that's one of the other benefits of trading options as opposed to just letting your money ride in an ETF is that you get weekly money, you get liquid money in your bank account that's just like a paycheck. And by no means am I bashing ETFs. I think you should also have a portion of your investment portfolio in these indices, just because you can be more diversified that way, but also because it's easier, right? Some money you can just let it sit there and let it accrue interest and stock appreciation by doing nothing. You're making money while you sleep, much more passively than with options trading. But I also think it also prevents you from blowing up your entire account. Meaning if you have 25,000 total in your savings account and you're trading with 25,000 as well, well, what happens if a few options trades go against you, or you get assigned shares that now those stocks plummet because we're in a recession? Now you're caught bag holding with all of your savings. So I think you should also keep a portion of your portfolio or a portion of your investment money tucked away in ETFs and index funds. That way, if things do go south with you in terms of your options trading, you still have some money on the sidelines that was kind of sheltered or protected away. So let me know what you think about this video. I know it was one of my longer videos, but I just want to kind of explain a lot of my trades and how my thought process works in terms of my profit loss. As always, if you have any questions or comments, leave them below. And like I said, I'll make a video like this every month, and just to keep track of my profit loss statements for the coming months and years. And as always, happy trading.